mistakes to avoid when buying a car. The first one is, it's not really understanding how much you can afford. Most people, when they're looking at a car, they're just going to remote control and say, okay, well, it's going to cost me $123 a week. It sounds about right, I'm sure I can afford it. And typically they get caught up in the whole emotion of buying the car and really don't put a lot of thought into it. So actually sit down and say, okay, well, can I afford that $123 a week or $500 a month? And do I have enough fat in my budget to be able to afford that on the long term if there's a couple of other things that come up that you had planned from a spending point of view? Number two, buying new versus used. Your cars depreciate 30 to 40% in the first 2 years. Do you really need to be buying a new car? Now, if money's not an issue, because there are a few people out there that money is not an issue to, then buying new is okay. But I think if it's not, then you really need to seriously consider whether used is a better option for you. Number three, not knowing the true cost of the deal. Just because it might have a finance rate of 9, 10, 15%, whatever it happens to be, what other costs do you need to add on to that? Is there an insurance policy fee that you have to pay to make sure that your loan is covered if something happens to you? Are there any other financing costs on top of there? Are there any other maintenance costs that you're not really sure of that need to be on there? So just work down what is the true cost of that deal, because again, it's not just the $123 a week. Choosing to, same before, choosing a long-term loan over a short-term loan. Because the longer you take out the loan, of course, the more the interest costs are going to be. And one of the mistakes that people make is they put their car loan on their mortgage because it's a cheaper interest rate. So let's say that you're paying 8% on your mortgage, but you're paying 15% on your car loan. On the surface, you may think, okay, well, it's cheaper to buy it through my mortgage. However, if you've got a 25-year mortgage, you're actually paying that loan off over 25 years at 8%, as opposed to paying it off over 4 years at 15%. It's going to be, even though the interest rate is higher, it's actually going to be cheaper for you from an interest cost perspective because the loan is shorter. So really just think about balancing out the interest rate that you're paying and the term of the loan. Mistake number five is being upside down on your existing car loan. So in English, what does that actually mean? Well, that means that if you decide that you want to sell the car, that the loan is actually much higher than what the value of the car is. And this is something that I've come across on quite a regular basis, because what will happen is people get into a bit of trouble financially and I think, oh, we'll get rid of the car, pay it off and downgrade the car. But what they find is that they owe $20,000 on the loan and the car may only be worth $13,000. So it's just something to be aware of. Now, having said all of the above, cash is king. So in my perfect world, I'd be saying to you, save for it, put an amount aside in your budget, put a provision in every month, and so that when you've actually got enough money, you can go and buy cash for that car and get a really good deal.